So I'm going to talk about a couple examples here about the Laffer curve. So in 1930, I guess I'll write it out here. So 1930, this was called the Hawley suit? The Hawley, what was the other guy's name? Hawley-Smoot tariff. Okay, this is a big example. So essentially what happened then is they decided to, in the United States, they decided to raise the taxes on specific goods by 5%. So it went from like 13.8% to around 19%. And they thought, okay, well, this is going to bring in a lot more tax revenue. But what happened because of that is that people stopped buying those goods. And so that bill, by increasing taxes on these goods by 5%, they actually ended up reducing the revenue brought in by those goods by 55%. And so they pretty much abolished that bill, as I could research. So that's an example of the Laffer curve. All right, raising taxes doesn't always bring in more revenue. And one more example, which I talked about, is which is very important for Trump's plan, is this next one. I think it was 1981. Reagan went into office, right? 1981. And so the top tax rate was 70%. Top tax rate, so that's 70%. Okay, top tax rate was at 70% for the richest of the rich. For the average person, it was like 40% or 45 or something like that. But the top tax rate was 70%. So what he did was he reduced it to 50%. Which many liberals did not like. But the result of this was something quite interesting. So it increased income inequality, I will say that. By doing this, it did increase income inequality. So the rich got richer, poor got poorer. But what actually happened was the revenue brought in by the richest of the rich almost doubled. So it essentially doubled. So it doubled revenue. So it doubled revenue of the people being taxed like that. So I think the numbers were the taxable income from the rich. The amount of income that the rich brought in went from 22 billion to 49 billion in a span of 3 years. So more than doubled the revenue. Again, so these tax cuts made people want to pay their taxes, obviously, and maybe grow their business more and bring money back into the States. Now, there was a lot of other reasons for this, by the way. You know, the population increased, there was inflation, although this is accounting for inflation. You know, population increased, maybe it was just part of the cycle. You know, the economy kind of goes in cycles for the most part, right? Especially in the stock market. But even when you account for all those things, you know, doubling the tax revenue from one bracket of income, it has to be from something like this, at least partially, right? So 1981, that happened. And so that's kind of similar to what Trump's going to do now. And I'll explain more about that. This is going to be a long talk, by the way, everyone. This is going to be one of the longest talks I've ever given. So stick with me, because this is a big thing to cover. I read through all of their policy plans, and boy, oh boy, do they have opposite plans. So one more example. This is an opposite example I'm giving. So George Sr. So George, almost spelled his name wrong. George Bush, 1991. What he did is he upped taxes on luxury items. So we're going to call it a luxury tax. So he developed this luxury tax. And so essentially what he did is he increased taxes on all cars that were above average, all boats, yachts, jewelry, aircrafts, anything that a rich person would buy, right? And so he increased these taxes by a little bit and expected, by not a little bit, but actually it was a fair bit. It was like 10% or something. And essentially it was projected to increase the tax revenue by $9 billion a year. But So what happens is he introduced this luxury tax, and people stopped buying those things. People stopped buying all of those high-end equipment and automobiles and aircrafts and stuff like and jewelry. And so what actually happened, people bought less of those, and then those companies that were doing okay before the luxury tax, they went under. And the normal middle class people lost their jobs, and it actually took a decent hit to it actually hurt the economy. Like, surprisingly, this one little tax on luxury items hurt the economy, the American economy. And so that's an example of how when you increase taxes, sometimes it can hurt the economy of the United States or of wherever the country is, not just the States, right? So they eventually canceled this. I think it took a year or two for them to cancel it. So just to kind of summarize on this background information, lower taxes usually create a larger sized economy for the most part. You have to have a little bit of tax to make the government function, but for the most part, lowering taxes creates a bigger economy. Saying that, that's not necessarily what's best for the country, right? Higher taxes usually create a better quality of life, I should say. I'm trying to word this properly without having a bunch of people disagree with me. So raising taxes, it usually creates a better quality of life because you get things like paid health care, which the United States doesn't have, daycare, maternity leave. Paid vacation, just random stuff like that. And so people are usually happier even though taxes are higher and they can't really be as rich as they dreamed of. So we're going to get to that when we talk about Bernie a little bit. So this is just the background info which I wanted to get to. Now we're going to talk about specifically Donald Trump's economic plan first, and then we'll talk about Bernie's, then we'll compare. All right. So what do you guys think about this? Are you agreeing with what I'm saying, even though it's true? Again, this is kind of like a high school to university level economic concept that I just taught to you guys. Hopefully you guys can understand it, because I know it's not for everyone. All right. All right.